Good morning, everyone. Today is August 12th, and this is the internal strategy call for Zacks Professional Services. This morning, the markets are getting a nice boost off the back of last night's late day sell-off. And what we've got is actually a really decent read on not only headline CPI but core CPI as well. So that would be less the food and energy. So the headline CPI number came in at 0.6%, which was 20 basis points higher than expected. And that's basically in line with the CPI headline read reported a month ago. So I'm basically referring to the month-to-month numbers. And if you basically subtract out that more volatile food and energy sector, you actually get the same number, which is actually really, really positive. So 0.6% remains the number, and that's basically a 3x beat over the 0.2 that was expected to report. So this is definitely good in terms of the green shoots that we're looking for economic recovery out of this pandemic-induced recession that we're in. And so what I like to do when I see these types of numbers, and what I'm going to do is I'm going to go from Advisor Tools now and go into the research system. Today I'm going to spend some time kind of bouncing around a little bit. We're actually going to look at how to do a practitioner study on some information that I found very valuable, not only in the Wall Street Journal, but in backing through the monthly investing update and asset allocation report that John Blank puts out. So we're going to go through that. And then we're also going to take a look at the headline that I saw in the Wall Street Journal on Monday about tech takeover of the indices. So the very first thing I want to do is cover this topic of CPI, and then we'll move on from there. Again, when I look at CPI, I love to take a look at a little bit more of a historical trend, not just any sort of a 1 year to 1 year change, or a 1 quarter to 1 quarter, or 1 month to 1 month. Hands down, the most valuable read of CPI and CPI core is going to be a year-over-year percent change. So all I did in here was literally create a 1 to 4 panel chart in the Zacks Research System. I did this morning after the news broke about the CPI. And all I did was go into the economic database, and I literally just transformed them into 1 year percent change series. And so I can see visually that based on what was reported today, that we're going to have a 1% year-over-year change in headline CPI, which is this top chart. So within the next day or so, once the database group gets the new CPI data into the Zacks Research System, you're going to see this line pop all the way up to here. The real news is what's going on with the CPI core. And you can see that we had obviously a really precipitous decline. I mean, this is definitely deflationary forces at their best. The core is just a really, really good indicator of what's really happening, with the pulse of the economy in terms of pricing. And the nice thing is that this is actually a 1.6 increase on core. So we're going to go from a 1.19 up to a 1.6. So just visually, that's going to take us just shy of this line right here, which is a nice rebound in CPI core. So that's one of the reasons why we have such a nice little rebound in store for us today. And again, over the last couple days, we've seen another attempt at a rotation into value. And I'm not saying that that's unraveling. Certainly with these types of green shoots that are showing in the economy, a value rebound is warranted. But we'll talk a little bit more at the end, towards the end of the call, about how much mega cap tech and some of these tech names can really sell off while investors seek this value opportunity. Just to give you a little bit of a hint, when you start talking about the top 5 names in the S&P 500 being tech names, making up 23% of the S&P 500, and think about the billions, if not trillions of cash sitting on the sideline, any investment that goes into the Qs or goes into the SPY, you're going to have somewhere between 23 and 35 to 40% of those assets go straight into the top 5 names. So again, the tilts are designed strategically to, for just that. They are long-term strategic tilts, and they protect us during these times. So I'm not expecting that to change anytime soon. But again, we'll talk a little bit more about that in a minute. So the next thing I want to discuss, and I'm going to go ahead and minimize the Zacks Research System here for a minute, is this Wall Street Journal article I found on lumber pricing. And it's interesting because I've had a couple of client calls and even prospect calls here within the last week or two where I've gone through John Blank's monthly investing update and asset allocation, and specifically have gone down to the material space because obviously I've been looking at copper prices, lumber prices. There's been a lot of these types of green shoots in the commodity space that have given rise or piqued my interest, if you will. And so when I saw this article pop up in the Wall Street Journal, I said to myself, this is relevant. This is something that advisors could really use, kind of a full synthesis on how a practitioner, somebody managing a portfolio, would look at this article and go, gee, I wonder if there's something I could do here in Advisor Tools to position my portfolios accordingly. And ultimately, this ends up coming around full circle to our ETF Rank, which is going to be one of the focal points of my discussion here. So what I want to do is actually talk about John Blank's report, and it's the monthly investing update and asset allocation report. And keep in mind that the Wall Street Journal is now reporting that wood prices are approaching record highs, and it's due to a lot of these DIY projects. And interestingly enough, if you go to page 2 in the article, they talk about do-it-yourself projects driving up the price for wood, and then they actually bring in some residential housing starts and new building permit data. And I really don't like the way the Wall Street Journal charts a lot of these charts. They don't give you enough history to see how far back this trough really goes. In other words, how far back in time do we have to get where we're at levels today at the bottom of this trough. So we're going to do that here in just a minute. But what I wanted to show you was the report itself, but I also want to show you where to find it in Advisor Tools. And it's this under market strategy. We have an entire library here that for the most part, John Blank and Shiraz Mian, head of research, they manage this for us. They do a really great job. The monthly investing update and asset allocation piece is really important, because if you think about the way we view ETFs, or the way any advisor views an ETF, is they're primarily instruments for asset allocation purposes, right? So what John Blank does in this particular document is he is basically compiling inputs from a myriad of sources, right? We've got these individual asset class and industry forecasts coming from the Zacks proprietary models. We've got an investment committee here at Zacks. We've got Zacks consulting economists, as well as consensus economics and the San Francisco Fed views. And probably the most important one of all, and this is what really differentiates us from the rest of the sell side making these types of forecasts, is that we are not only surveying sell side investment strategists like everybody else does, but what we do differently is that we actually pull buy side chief investment officers, so CIOs. And so I would argue that our forecasts for asset class returns are probably some of the most predictive out there in the marketplace, just because they're so well-rounded. And what you find when you go into this document is you find, equity returns for not only all the different style classifications, but for geographic regions, and that includes all the 20 major countries outside the U.S., fixed income rates, mortgage, corporate bonds, U.S. Treasuries, Forex, foreign exchange, commodities, all in there. It's a great document. And so this is the August document. Everybody's going to notice the August document. We've got some new formatting and it looks really, really sharp. This is obviously going to be a precursor to these specific tables being present in Advisor Tools, and that's coming. That's something that Jeff and Adam are working on diligently. The report looks really great, and all of what I just mentioned is in here with pretty charts, and clients can really, really get some value out of this, and I'm going to show you how to get the most value out of it. And when you see an article like what I just showed regarding the lumber prices, my memory serves me correctly when I go down to this materials sector and I look at the very attractive column, and I see that building products and construction materials is actually very attractive. And so in preparation for this call, which I don't do a whole lot of prep for, these calls are strictly impromptu for the most part. I did send an email over to John Blank asking for a historical group of these outlook reports so I could trace back when this actually made the change. And in June, it was unattractive, and then July became very attractive. So this is the July materials sector. And again, building products and construction materials showing up as very attractive. And again, when we start asking ourselves, why is this important? The reason this is important, and I'm going to show you evidence from an individual security perspective in just a minute, is that keep in mind that ETFs are, again, instruments for asset allocation purposes. It's these asset class forecasts that are discussed in this entire report that are used to drive that award-winning Zacks ETF rank. And that is in conjunction with 7 other factors. So in other words, the outlook for the underlying industry and asset class returns, when you combine those with specific ETF attributes, that is the ETF rank. So what I want to do is look at how powerful this is from an individual security perspective. So we know that in July, we went to very attractive in the materials sector, and specifically on the industry side, building products and construction materials. And I was on the phone probably 3-4 weeks ago with a client, and we were talking about the lines in Home Depot to basically buy lumber. And the very first thing I want to show you is this housing starts and building permits chart. And I literally replicated the chart with that we saw in the Wall Street Journal, but with a much deeper history, so that you can see that we actually went all the way back down in terms of housing starts to 2013 and 2014 levels before rebounding back up to what I would call median range now for 2015 to present. So when you're looking at the Wall Street Journal article, you can see that the chart looks pretty, but it doesn't really tell you, excuse me, I got to find where that article is. Here it is. It doesn't really tell you how deep that trough was. So 2014 comes all the way back here. This goes back to 2016. In ZRS, obviously, you've got full control. You can go back as far as you want. But this is a very stealthy rebound in not only housing starts, but building permits, which one leads the other. So the idea is it's not just do-it-yourself projects that are driving up the cost of lumber. It is this boom in housing. So I was on the phone with a prospect. We're looking at stocks, and the topic of Boise Cascade comes up. And Boise Cascade, obviously being one of the largest lumber companies, you can see what happened with Boise Cascade, right? We fell off a cliff like much of the more economically sensitive stocks would do. And then with the stay-at-home orders and all the DIY projects that started, you can see that Boise Cascade and their lumber production, I mean, just absolutely, through the roof. And lumber prices have actually followed this chart. But you can see that Boise Cascade nearing pretty much all-time highs now, after we literally fell off a cliff here back in February. But as far as the Zacks asset allocation report and we take a look at that, July timeframe, it's very timely because that call to very attractive took place right about here, and you can see what's happened ever since. And speaking to that client, I was in Home Depot, noticed the lines on the pro side for lumber. He was there, lumber, plywood. We started talking about it, and we looked at Home Depot stock specifically, and I'll just make sure we got enough history here. It actually looks pretty decent on a 20-year chart, but what I want everybody to see is this time frame here. And Home Depot is obviously an earnings certain portfolio member, as is Tractor Supply. And yeah, believe it or not, we actually did change the stock. I know it doesn't look like it, but you guys see exactly what's going on. And keep in mind that call to very attractive was obviously right here. And it's been largely the demand for materials that have been pushing these names up even further. And you're seeing that again, Home Depot, Tractor Supply, Lowe's. And this is just a simple, in this case, again, right mouse click history, a 20-year price and earnings chart within the Zacks Research System to be able to do this kind of analysis. So again, to kind of bring this full circle, the idea is that this information that John Blank puts together in this monthly investing update and asset allocation, this report just came out August 7th. The last one came out in July. We had this it was actually the beginning of July. We had this ranked very attractive. We have this for every single industry, for every single sector. And at the bottom of the report, we actually give you asset allocation guidelines. Again, to bring this all full circle, you can take this to the ETF level. This is what Nina Mishra does on the ETF side in actually choosing the ETFs for our ETF model portfolios. Again, this is all driven top-down asset allocation, and then utilizing these industry returns and these industry guidelines, being able to choose those ETFs that best fit these venues. You can bring it all the way down to the individual stock level with the Zacks Research System and selecting individual equities. So kind of a full circle synthesis for everyone as to how powerful this report is and can be even to financial advisors, anyone really managing their own portfolio of either ETFs or equity securities. If you're only managing to ETFs, the idea is it's a really, really good idea to understand where these forecasts are coming from and how that's actually impacting the asset allocation, because ETFs are, again, a tool for asset allocation, or I should say an instrument, we like to call it, for asset allocation. So the last thing I want to do is take a look at the headline that made news on Monday morning. And this kind of popped me up in my chair as I was reviewing the Wall Street Journal first thing Monday morning. And, keep in mind, it was right around the end of March that, we made the call in terms of the tilt strategies, and we've still got a tilt webinar available on our ECP channel on YouTube that can be watched. And, we made the call right in here that, hey, the winners in this recession on the way out are going to be big tech, and here's why. And so, if you read the article, it's basically about what the caption says, right? The mega tech stocks, specifically these 5 names that I keep talking about as well, are reaching new heights. And that in and of itself has scared some people. And again, more than happy to do a strategy session with any of our clients who are nervous about big tech and the tilts, because the idea is it's like a chess game. And I show how profitable these companies are. If you go into the Zacks Research System, I have a composite of big tech that we've made available to everyone that subscribes to the research system. It's called the Earnings Certain Tilt Portfolio, and this is basically the top 5 plus Adobe. And just doing some simple return analysis Return on capital. I know this is something that Meyer loves to look at these charts as well. But you see that, these companies are almost 3x more efficient at returning capital, returning net income on their capital structure. You're just not going to really find a group of stocks like this outside of the earnings certain stocks that can do this. Even to common shareholders, if we look at ROE, you're talking almost 2x more efficient than the S&P 500 market weighted. And you're not going to get these numbers from S&P. S&P doesn't publish these numbers. These numbers come straight from our composite facility, where we bottom up reconstruct the indexes themselves into composite proxies. And probably the most important one of all is when you look at the company's collective ability to generate free cash flow on invested capital. And for the 6 tilts that we recommend, it's more than 2x more efficient. And it's not just more than 2x more efficient, this year. It's last year, it's 18, it's 17, 16, 15. I mean, the charts don't lie. The idea is that, we should not fear big tech for this reason. This is where the returns are coming from. Big tech has led the triple Qs and the S&P 500 since 2012, 2013, ever since Apple started knocking out ExxonMobil as the largest company in North America, et cetera, et cetera. And I don't see this really changing anytime soon when you take a look at how diversified these companies are, and the fact that not only do they have reach here in the United States, but these are literally global behemoths. So you've kind of got your global exposure addressed as well, especially from a growth perspective. So what I did is I went back to my spreadsheet and actually calculated this, as I do on a regular basis, monitor the progress of the largest stocks relative to the smallest stocks. And you can see that on the small cap side of the S&P 500, I should say the smaller cap side, we've still got trouble down below. A lot of negative 50s, 60s%, 45s in here I see. And if you scroll up to the top, the cream of your leadership, you've got Google here that's about even. And again, this is from 220. This is pandemic returns, 220 to 87. And the rest of these are just basically pulling that tilt recommendation forward along with Adobe here. But the most important part of this chart or this table is the fact that now the bottom 370 names in market cap equal the top 5. And if it's the top 5 names that continue to pull the indexes, the triple Qs and the SPYs, the ETFs to track them higher, and you can simply invest in 5 stocks that give you that tilt that is equal the weight of the bottom 370 names in market cap that simply aren't performing, then you've got a pretty good strategy from a macro perspective. And it's these types of tilts that we will take forward as we go through this process with recommending tilts for the ECP going forward. This is the thought process. It's large macro tilts, not trying to capitalize on a 1-week change because we think somebody's going to blow their earnings out. No, these earnings surprises on the positive side that we get from these companies are there for a reason. And their leadership is there for a reason. And I do want to reiterate, for anyone who has fears about how far these companies have run and how far these companies have grown in terms of their size, that plays to their advantage when we start talking about this trade-off between growth and value. And again, we've got billions, if not trillions, of cash sitting on the sidelines waiting to be redeployed, looking for green shoots, right? So the green shoots are here, and obviously we've got a lot of value in the S&P 500, but we've got a lot of growth. Keep in mind that when somebody invests $1 into SPY, 23 cents of it goes into those 5 names. So you've got really good support technically for pricing and valuation levels for these companies. In other words, how much do we really expect to come out of these 5 names to go chase value? The other thing is, keep in mind the entire premise behind the difference between the earnings certain portfolio's 75 stock portfolio, which you can see here, 20-year chart, is I basically stripped the 45 value names now that have been subject to some sort of reopening phenomenon that caused this dip in earnings. I stripped those out, and the remaining 30 stocks are what a lot of our clients are now using as their models, which is the ECP Admiral, which straightens that line back out. If you're following the 75 stock ECP Core, you've got 45 names in there in Core that are essentially value plays now, okay? And if you're using the Admiral portfolio, you have basically rock solid growth coupled with whatever you're doing on the ECP tilt side, which is going to give you that much more beta and that much more growth. So two very, very well positioned portfolios, regardless of what happens between this concept of growth and value. So that's what I wanted to leave you with today. Obviously, if clients or prospects have any questions, feel free to schedule a call with me. Happy to review advisor tools, the research system, spreadsheets, PowerPoint slides, whatever they need. Happy to do the review. Thanks, everyone, and we'll talk again next week.